In this video, we are going to talk about stock market crashes, how to prepare and not panic. 1 minute, the market's hitting record highs. The next, blammo, we're in the throes of a stock market correction. The most recent stock market crash was at the start of the COVID-19 pandemic in early 2020. The pandemic, inflation and the war in Ukraine continue to be drivers behind market volatility. But the stock market doesn't require a pandemic to enter into decline. Market downturns are normal and can be caused by numerous factors. Throughout the beginning of 2022, the markets have been experiencing extreme volatility over concerns about rising inflation and interest rates. Although history can tell us how long crashes, corrections and bear markets have lasted, no one gets a calendar notice announcing the time, nature and projected magnitude of future dips. What is a stock market crash? While there's no specific number that indicates a crash, here's a bit of context. The S&P 500 stock index typically changes between -1% and 1% on any given day. Anything outside these parameters could be considered an active day on the stock market, for better or for worse. If the S&P 500 drops 7% in a single day, trading may be halted for 15 minutes. This has only happened a handful of times in the market's history, and indeed marks a very bad day on Wall Street. A crash is marked by a sharp and sudden drop in stock prices, usually following an uptrend in the stock market, also known as a bull market. Stock market crashes in history. Even though the stock market has its roller coaster moments, the reality is that stock market crashes aren't that common. A few of the major U.S. stock market crashes of the past 100 years include 1929. The stock market plunged in response to a contracting economy and investor panic, marking the onset of the Great Depression. The market bottomed out in 1932, more than 80% below peak prices, and took over 2 decades to recover. 1987. The market plunged 25% in response to market decline, investor panic and early computerized trading gone awry, on a day known as Black Monday. However, the market recovered within 2 years, and the Securities and Exchange Commission implemented trading curbs and circuit breakers to prevent panic sell-offs. 2000. Following a surge of investing and speculation in internet-related ventures during the 1990s, the dot-com bubble burst in March 2000. The S&P 500 dropped nearly 50% and took 7 years to recover. 2008. In response to the housing bubble and subprime mortgage crisis, the S&P 500 lost nearly half its value and took 2 years to recover. 2020. As COVID-19 spread globally in February 2020, the market fell by over 30% in a little over a month. But by August 2020, the market had already rebounded, taking 6 months to recover. Here's a look at what the S&P 500 is doing today compared with the previous trading day's stock market data may be delayed up to 20 minutes, and is intended solely for informational purposes, not for trading purposes. If you have a long investment timeline and are properly diversified, it's often best to ride out the downturns. And understanding that a crash could happen means you can plan for it and react thoughtfully. Here's a 5-step game plan for what to do when the market crashes. 1. Know what you own, and why. A fear-driven reaction to a temporary slump isn't a good reason to dump an investment. But if you look back at your original stock research notes, you may find some good reasons to sell. Thorough stock research includes a written record of the strengths, weaknesses and purpose of every investment in your portfolio, as well as things that would earn each investment a place in the out box. Your research is like an investing roadmap, a tangible reminder of the things that make a stock worth holding. 2. Trust in diversification. When a market decline hits, your results may vary, and perhaps for the better, if you've invested money across different baskets of asset classes like stocks and bonds. Diversifying, or distributing your money across investments, is key to reducing investment risk and smoothing the ride through a tumultuous market. Diversifying helps ensure your investments, eggs, aren't concentrated in one type of asset basket. So if one stock or industry has a bad day, your other investments may help offset those losses. If you've gone with a set-it-and-forget-it strategy, like investing in a target-date retirement fund, as many 401k plans allow you to do, or using a robo-advisor, diversification already is built in. In this case, it's best to sit tight and trust that your portfolio is ready to ride out the storm. You'll still experience some painful short-term jolts, but this will help you avoid losses from which your portfolio can't recover. 3. Be ready to buy the dip. Market dips can also be a buying opportunity. Think of it as buying stocks on sale when the market crashes. The trick is to be ready for the fall and willing to commit some cash to snap up investments whose prices are dropping. Here's how to tell if you might be ready to buy the dip. You already have an emergency fund, you've allocated money for retirement, and you have cash available for everyday expenses. You've set aside some cash. So you're ready for a flash sale when disaster strikes, and you keep a running wish list of individual stocks you would like to own. If you do buy the dip, you probably won't catch the stock at its low, but that's fine. The point is to be opportunistic on investments you think have good long-term potential. 4. Get a second opinion. Being an investor is rewarding when the stock market's on a tear and your portfolio is going up in value. But when times get tough, self-doubt and ill-advised tactics can take root. Even the most confident saver investor can fall victim to harmful short-term thinking. Don't let self-doubt sabotage your financial plans. Consider hiring a financial advisor to kick the tires on your portfolio and provide an independent perspective on your financial plan. In fact, it's not uncommon for financial planners to have their own financial planner on their personal payroll for the same reason. An added bonus is knowing there's someone to call to talk you through the tough times. Looking for an advisor? We have a list of the best financial advisors. 5. Focus on the long term. When the stock market declines, it can be difficult to watch your portfolio's value shrink and do nothing about it. It can be especially hard to watch your portfolio shrink in a year when you might have gotten sick, grieved, or lost or changed jobs due to the COVID-19 pandemic. It's normal to feel pessimistic after a crash. But if you're investing for the long term, doing nothing is often the best course. It's important to remember that when you sell investments in a downturn, you lock in your losses. Take the February 2020 COVID-related market crash. Say, you'd had $1,000 invested in an exchange-traded fund, or ETF, that tracked the S&P 500. Such a fund would have lost more than 30% of its value during the spring 2020 crash. If you'd had sold, you would have locked in that 30% loss, but if you'd held onto it, you would have recovered your losses by August and watched it grow since. Please leave a comment below if you have specific content ideas, and don't forget to subscribe to our YouTube channel. Thanks for watching.